While there are many paths investors can take to generate long-term wealth, our preferred method is to buy and hold shares of high-quality dividend stocks for the long run. There are many different kinds of dividend stocks, which can be overwhelming for investors starting their search. We think many investors would benefit from the safety and growth of the dividend aristocrats. In this article, we'll take a look at what makes a great dividend stock, and why we specifically favor the dividend aristocrats. What income investors should look for in dividend stocks. There are a few key characteristics that investors should look for when it comes to picking the best dividend stocks. First is dividend sustainability. Many stocks that pay dividends do so with unreasonably high payout ratios, unsustainable competitive advantages, volatile earnings streams, or other issues that prevent them from being strong long-term picks. When we are looking for great dividend growth stocks, they are the antithesis of the characteristics just described. The best dividend growth stocks are able to pay dividends that expand over the long term because they have sustainable competitive advantages that can survive tough periods, such as recessions. In addition, these companies have management teams that are committed to returning excess cash flow to shareholders in the form of dividends. As these companies continue to enjoy the rising earnings that sustainable competitive advantages bring, they are able to return more and more of their excess cash to shareholders via rising dividends. Finally, growth is terrific for dividend stocks, but the dividend payout must be able to survive recessionary periods as well. That means that dividend stocks must pay a reasonable amount of earnings to shareholders each year, as measured by the payout ratio. The best dividend stocks strike a balance between paying out as much cash as possible and being able to sustain that payout during the inevitable weak periods that pop up over time. By contrast, low-quality dividend stocks might pay 100% or more of their earnings, sometimes using debt to maintain a dividend payout. This can provide high yields in the short run, but it also means the odds of the payout being sustainable over the long run are quite low. The benefits of choosing quality. These characteristics lead to strong benefits for those holding high-quality dividend stocks, and these benefits are why we like them so much. Strong dividend stocks tend to hold up better during recessionary periods, given that their earnings streams tend to hold up more so than companies without sustainable competitive advantages. Indeed, nothing tests a company's competitive advantage quite like a recession, so this is where high-quality dividend stocks can shine. The other obvious benefit is that these stocks are able to pay growing income to shareholders over time, meaning that the investor's yield on cost should grow more and more over time. When compounding wealth for the long term, this growing yield on cost means that the investor's return on their original capital grows ever higher as the years go on, and the dividend increases keep coming. That allows for even faster compounding, creating a virtuous cycle of rising income. Now, let's take a look at some examples of great dividend stocks. Examples of top dividend aristocrats. The dividend aristocrats are a group of stocks that are S&P 500 components and have increased their dividends for at least 25 consecutive years. By eliminating stocks that cannot raise their dividends during recessions, we can hone in on just the best of the best, and the net result is the dividend aristocrats. In order to make the list, each stock must have the ability to pay rising dividends over very long periods, and have management teams that are willing and able to do so, even through recessions. For long-term investors looking to compound their wealth, this is exactly where they should be focused. 3 of the best examples of dividend aristocrats, and therefore, great dividend stocks, are McDonald's, MCD, Procter & Gamble, PG, and Walmart, WMT. All 3 are in different sectors of the stock market, produce very different streams of revenue, and make their earnings in different ways. But what they all have in common is decades-long dividend increase streaks that were made possible by great businesses that sustainably outperform their peers. All 3 of these businesses compete in extremely competitive fields, with McDonald's in the restaurant business, Procter & Gamble in consumer staples, and Walmart in general merchandise retail. All of these sectors have intense competitive landscapes and a huge amount of choice for consumers. However, despite these natural headwinds, all have managed decades of consecutive dividend increases. Different companies compete on different strategies, and with these three examples, we see at least two distinct ways of creating a competitive advantage. In the case of Procter & Gamble, it has been able to raise its dividend for an incredible 65 consecutive years because it has created numerous brands that are upmarket for consumers looking to buy things they need for daily life. This strategy of being at or near the top of the market for a product, and having the branding and name recognition to achieve it, afford pricing power over time. That allows for reliable earnings and strong margins that combine to create steadily rising profits. McDonald's and Walmart, on the other hand, compete in size and scale, as well as the value proposition to the consumer. While these companies operate very different businesses, they both have proven the ability to win in very competitive markets because they offer a superior value proposition to the consumer. This is the opposite of Procter & Gamble's strategy of being upmarket, where McDonald's and Walmart are appealing to a variety of consumers. The point is that there's no one correct way to achieve a competitive advantage, but for those that do, it can be quite lucrative for shareholders of those companies. Final thoughts? While there are many ways for investors to compound their wealth over time, we believe the best time-tested strategy is to find high-quality dividend stocks, hold them for the long term, and reinvest dividends to speed up the wealth compounding. The dividend aristocrats are a great place to start as all have multiple decades of consecutive dividend increases, but not all are created equal. We especially like stocks with strong moats, such as McDonald's, Procter & Gamble, and Walmart, which have proven the ability to grow earnings and dividends under virtually any conditions.